We've had a decent sell-off so far in a lot of the tech stocks in 2026. I couldn't be more excited. I have a watch list of stocks I would love to buy at the right price. I'm gonna talk about two of those stocks today, so I really hope you enjoy it. Now, I talked about the market crash before a few weeks ago, and I told you guys I wouldn't be surprised if we still go lower on the Nasdaq, potentially 10%, revisit the previous high. I think it would be very healthy. And the main counter argument I get in the comments is if we believe the market could go lower, or some people believe we're going to have the crash of a lifetime, why am I buying stocks right now? And why don't we just wait for the market to bottom out? And this is a big mistake that a lot of investors make, because many stocks could potentially bottom before the market actually bottoms. An example of that is Constellation Energy, which I talked about the stock many times. The stock could have potentially bottomed out. It's up more than 30% from its low just in a few weeks, and I've been averaging up on the stocks. I bought the stocks 3 times and I just couldn't catch it. And many stocks have kind of bottomed out and they started to move up. And the same thing could happen, which is why I buy stocks based on the fundamentals, not just based on the market. Now, the first one might surprise some of you, and this is Nvidia. Nvidia is down 7.5% over the last 5 days. I'm very interested in owning Nvidia, as I think of Nvidia and semiconductors in general as a hedge against my big tech kind of stocks. Because I own Amazon, I own Meta, I own Microsoft. They're spending over $600 billion on CapEx, and the CapEx spending will likely continue to go up. And those stocks would potentially suffer in the short term because of this CapEx, but who's going to benefit if they increase CapEx? It's Nvidia. So Nvidia by itself is an amazing company, but Amazon and Microsoft and Google and Meta, they're also amazing companies, but it's also some kind of a hedge where if you own all those hyperscalers and they're going down because they're spending a lot on semis, it's not the worst idea in the world to hedge against it by owning a semiconductor stock, which is why I'm getting very interested in Nvidia. Now, many of you might ask me, what about AMD? You've been talking about AMD a lot. You talked about the stock. You own the stock. I had call options on AMD. I took profits of 340% at $225, and I haven't gone back in AMD. I'm not a big fan of the CEO giving away 20% of the company in stock, even though they vest at $600, but you're still getting diluted 20%. And that really signals, you could say, desperation to me in the short term if I want to be a long-term investor in AMD, which is why I haven't gone back in AMD, and I could potentially own the stock again if it goes maybe to 170, 165, and I'm going to talk about it in another video. But Nvidia is really amazing. 73% revenue growth. I'm really shocked by how sustainable the revenue growth of Nvidia has been, and it's been re-accelerating 73%, expected to re-accelerate to 79% revenue growth by the third quarter of 2026. This is a $4 trillion company, and they're growing revenues about 79%. Absolutely mind-blowing. And the most mind-blowing chart of them all is their data center revenues, which have been increased like never before. Really, really amazing. Now, if we scale or if we rank Nvidia's businesses based on AI disruption, most of them are 1 out of 10. Maybe PCs are 4 out of 10 as a score based on Claude in terms of AI disruption. And I don't see how Nvidia could potentially be disrupted. If anything, Nvidia is going to be the ultimate beneficiary of AI and all the dramas that we've been having recently around AI replacing everything and killing all the jobs and all these kind of things. But Nvidia does have a few risks. One of them is the custom AI chips from ABGO and Marvell, mainly ABGO. They've been partnering with Google on their TPUs. They've been getting popular. Amazon Trainium are also getting popular. Microsoft now has their own chip. And a lot of those hyperscalers are spending money for inferencing-related chips. They could do it in-house. They could save the money. And that's kind of pressuring NVIDIA a little bit. And that's going to continue to pressure NVIDIA as those hyperscalers will be ultimately pressured to cut back on CapEx. The second risk for NVIDIA is export controls to China and other countries, but mainly China, that could potentially affect the revenues in the short term. But the biggest risk, and this is mainly the moat of NVIDIA, you could say, is CUDA. CUDA is mainly the software attached to this whole business that makes it extremely difficult to move away from, let's say, NVIDIA to the AMD ROCm system or some kind of an other chip manufacturer system. The moat of NVIDIA is CUDA. Most of you guys knows that. Now, my main concern is, or my main question is, will AI make it easier for companies to switch from CUDA to our OCM or all those other companies? We have to think about it, because now it's very hard. It takes 6 to 12 months. It took Microsoft Azure to switch certain applications to AMD's MI300X, 6 to 12 months. For Meta, they're still trying to transition some inferencing, and it's taking a while. It takes many years. For Google, it's taking years. For OpenAI, since 2023, they've been trying to do it. So the transition out of CUDA is extremely, extremely difficult. And could AI make it easier for that to happen? Based on a lot of research I've done, it could reduce the cost and timing by up to 80%, in some occasions 60%, 15 to 20%, 25%, 40%. It depends on the model that's implemented in a lot of those hyperscalers, but nonetheless, over the long term, AI will make it easier for companies to switch away from CUDA and retrain into a different kind of system if they decide to do so, which is why I asked Claude about giving them some kind of a moat based on a specific year. Now the moat is 9.5 out of 10 for CUDA, but it's expected to decelerate to 5 to 7 out of 10 by 2031 as AI evolves in general. And AI just makes it easier. If you want to switch away from CUDA to another system, it's going to be much, much easier. And that's something that we have to think about over the long term. Something else that we have to think about as a long-term risk is competition from China. And this is from the CFO herself. She said, our competitors in China, blustered by recent IPOs, are making progress and have the potential to disrupt the structure of the global AI industry over the long term. I don't think that's going to affect them in the United States. United States is going to still be using NVIDIA chips due to national security concerns. But outside the United States, maybe China will be taking market share from NVIDIA, as they can potentially make them as powerful and like 50 or 70 or 80% less expensive. And that would be pretty disruptive to the chip industry, as we restricted China from exports on certain NVIDIA chips. And that's going to push them to create their own and innovate in general. So that's how it's going to work. And over the next few years, we will likely have much more competition. And I could potentially wait on NVIDIA's massive gross profit margins. Now, looking at NVIDIA's valuation, it's trading at 21 times forward earnings. 21 times is ridiculously cheap for a company. This is pretty much where it bottomed at before. It bottomed at 20 times, 21 times. And also in 2022, 2023, it bottomed at 20 times. So 20 times, 21 times has historically been a really good level to be buying NVIDIA. And by the way, I'm using Fiscal.AI to come up with all those charts. If you want to try it out, they give you 2 weeks of free access if you use my link in the description. But 1.5 times looks cheap. The biggest problem with semiconductors is predicting the cycle or predicting how sustainable those earnings are, because this is 21 times based on 72% earnings per share growth for fiscal year 2027. After that, NVIDIA is expected to decelerate to 29% and 21%. And semis in general have been cyclical. They will always be cyclical in my opinion. And it's really hard to predict how sustainable earnings per share or revenue growth is in general, which is why I like to use conservative estimates. Based on my estimates, I'm using the 73% growth expected for 2026, but after that, I'm using 20%, 20%, 15% for 2029, 15% for 2030. It could potentially be much more sustainable. It could grow 20% plus, but I feel more comfortable using the 15% range. The current 4P is 21 times. If we keep it at 21 times, I get about $330 per share for NVIDIA. 5 years from now, the current price is $177, which is about 86% on the upside, or a 13.3% annual return on NVIDIA from here over the next 5 years. This is not bad at all. If I want to get it double with NVIDIA over the next 5 years on what I believe are extremely conservative assumptions, I would have to buy NVIDIA at $165 per share. So for me, anything around 150 to 160, I'm highly likely going to be buying NVIDIA as a hedge for a lot of my hyperscalers. That's how I think about it. And I think NVIDIA is an amazing company. But to be honest with you, the stocks that I would love to own and I really want to own the stock much more than Nvidia, is AVGO, because I have a thesis that over the next few years, those hyperscalers will ultimately be pressured to cut capex, and the ultimate beneficiaries of cutting capex are AMD because they have the cheaper chips, and also AVGO. AVGO is an absolute beast, and I would love to own the company. It's down 8% year to date. It's been holding up better than a lot of the tech stocks. They make most of their revenues from semiconductor solutions, but they also have infrastructure software, mainly VMware, which they acquired a few years ago. It's about 6.9 billion, growing 19% year on year, and it's very sticky, by the way, which is really amazing. Now, looking at the moat of AVGO, the biggest moat they have is mainly the custom AI chips. They have over a 75% market share in the AI accelerator market. Google TPU works with AVGO, Meta works with AVGO, OpenAI works with AVGO, Anthropic works with AVGO. Most companies, they work with AVGO, and they have a 75% market share. The second moat, or the second business model of AVGO, is the Tomahawk, which is very popular in Ethernet switching and other kind of switches. They also have a moat over there, and a lot of companies use them. They expect to have about a 65% market share in this area. Really amazing. Then you have VMware, which a lot of people, I think, misunderstand the company. They have over 300,000 enterprise customers, and it's very, very embedded with 93% gross margins that delivers AVGO and annuity-like revenue, and I don't think it's going to be disrupted anytime soon. And those are really amazing businesses for the company. Now, the reason why AVGO is such an amazing company is if you compare the economics of the NVIDIA, let's say H100 chip versus the Broadcom ASIC chip. You compare the cost, it's $0 for NVIDIA. You don't have to put in any upfront, but for AVGO, you're gonna have to put in 300 to 500 million. For NVIDIA, it's available right now. For AVGO, it's a 3 to 5 year design cycle. But in terms of unit economics for NVIDIA, it's 25 to 35,000 per GPU. They have massive gross margins on them. For AVGO, is 60 to 70% lower. This is really, really amazing. It's absolutely amazing. For power efficiencies, it's pretty much baseline for NVIDIA. For AVGO, it's 30 to 50% better, which is really good. Now, in terms of who can afford it, everyone. For NVIDIA. For AVGO, it's only hyperscalers with 10 billion plus budgets. For the moat, in terms of NVIDIA, is CUDA. For AVGO, it's a 3 to 5 year redesign cycle, and they have to get them early and then redesign them and provide them a sticky moat and a competitive advantage. So the company is really amazing. But of course, they have some risks. The main one is over the very long term, over the next 5 to 10 years, a lot of companies like Google and Amazon and Microsoft pretty much designing their own chips without the help of AVGO. So far, Google is still working with AVGO, and AVGO has a lot of connections. They have a moat, I believe, around silicon and a lot of different materials and a lot of different design kind of prototypes, which isn't as easy as just like using AI to design a chip, and you don't need AVGO. AVGO has much more than just someone that just makes the design. But over the long term, there's a risk that potentially Amazon and Google will do it internally and they're gonna cut off AVGO. I doubt it, but it's possible. Then you have the competition from Marvell, which is, you could say, decent competition, but it has been losing the war so far. Now, looking at the multiple of AVGO, I try to keep it simple. The stock trading at 30 times forward earnings. I told you guys how hard it is to predict the cycles of semis and how sustainable the earnings growth of those semis are, especially if you're buying a $1 trillion plus stock that's historically cyclical in terms of earnings. I try to be careful. I try to be conservative. So it's now trading at 31 times earnings. I noticed that the stock tends to bottom around 23 times earnings. This is where it bottomed in April. This is where it bottomed before, 23 times. So there's a pretty decent, this is the line, 23 times earnings. It has been a good time to buy AVGO, so I'm trying to buy it near 23 times earnings. I try to keep it simple. Now, 23 times forward earnings for AVGO would be around $250 per share, or around 20% on the downside from here. which in my opinion is reasonable. It's possible, and I would not be surprised if it happens. I've seen it many times before where those stocks, they retest their previous high. AVGO could retest the previous high. It's only 20%. A volatile stock like this one could do it in 5 days or 7 days or 2 weeks during some kind of a flush if we do have one. But I believe AVGO here, to be honest, is really not bad because they're growing earnings 30% plus. I'm just not sure how sustainable the growth is, so I want a margin of safety, and I'm lining up 23 times earnings, which is about $250, $260 per share. And I share everything I do in real time. This is the link if you're interested. Thank you again for watching. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.